Discuss budgets and performance evaluation. Role of budgets in performance management. Budgets are central to performance management because they translate strategic objectives into quantifiable financial targets. They serve multiple purposes: planning, coordination, communication, control, and performance evaluation. Through budgeting, organizations allocate resources, establish responsibility centers, and define expectations. In evaluating performance, actual results are compared with budgeted figures to identify variances that highlight areas requiring managerial attention. Favorable variances may indicate operational efficiency, while adverse ones signal inefficiency or external challenges. CIMA emphasizes that budgets provide a framework for accountability, as managers are assessed on controllable aspects of performance. However, rigid adherence to budgetary targets may discourage innovation and adaptability, especially in dynamic environments. Therefore, modern budgeting approaches stress flexibility, continuous review, and alignment with strategic goals to maintain relevance. Budgetary control and behavioral implications. Budgetary control systems provide feedback loops that influence managerial behavior. When well designed, they motivate efficiency and cost consciousness. However, overly restrictive budgets may lead to dysfunctional outcomes such as budget gaming, slack creation, or short-termism. Performance evaluation must therefore balance financial discipline with behavioral realism. Participative budgeting, where managers contribute to target setting, increases ownership and commitment while improving forecast accuracy. Conversely, imposed budgets risk demotivating staff or fostering blame cultures. Beyond numerical targets, communication and feedback are vital in interpreting variances contextually, distinguishing between controllable inefficiencies and external disruptions. CIMA advocates performance reporting that integrates narrative analysis with quantitative data to ensure fair and informed evaluations. Key performance indicators, KPIs, and budget linkage. Budgets are linked to KPIs that measure progress towards financial and strategic goals. Common financial KPIs include profitability ratios, liquidity metrics, asset turnover, return on investment, ROI, and economic value added EVA. Profitability measures gauge efficiency in converting revenues into profit. Liquidity ratios assess solvency. Asset turnover indicates utilization efficiency. ROI and EVA assess overall capital effectiveness. Integrating these metrics into budgetary performance reports enables a holistic view of resource deployment and return. However, KPIs must be aligned with corporate strategy and responsibility levels. Divisional managers should only be evaluated using controllable indicators. Overemphasis on financial KPIs can lead to short-term orientation, ignoring long-term sustainability and intangible value drivers. Hence, organizations increasingly complement financial indicators with non-financial and strategic metrics for balanced evaluation. Benchmarking and comparative performance analysis. Benchmarking strengthens performance evaluation by comparing actual outcomes with internal or external standards. Internal benchmarking contrasts performance across departments or periods, promoting internal learning and best practice sharing. External benchmarking assesses organizational results against competitors or industry averages, revealing relative strengths and weaknesses. Budgetary analysis enriched by benchmarking provides context for interpreting variances. What might appear as underperformance in isolation could be acceptable when compared to industry norms. However, benchmarking requires comparable data, reliable measures, and contextual interpretation to avoid misleading conclusions. CIMA underscores that benchmarking enhances budgetary control by transforming performance evaluation from static compliance into continuous improvement. It shifts focus from meeting fixed targets to achieving best-in-class performance. Beyond traditional budgeting, adaptive and rolling budgets. Traditional fixed budgets are often criticized for rigidity in volatile environments. Adaptive budgeting approaches, such as rolling forecasts, beyond budgeting, and zero-based budgeting, aim to enhance responsiveness and strategic alignment. Rolling budgets continuously update targets based on current conditions, providing real-time relevance. Beyond budgeting advocates decentralize control and relative performance measures instead of fixed targets, fostering flexibility and innovation. Zero-based budgeting requires managers to justify all expenditures from zero, ensuring cost discipline and value creation. When integrated into performance evaluation, These modern approaches encourage accountability while adapting to environmental change. The shift reflects Chima's view that performance management should be dynamic, forward-looking, and strategically integrated rather than purely financial and retrospective. Evaluation, integration, and strategic relevance. Effective performance evaluation through budgets requires integrating financial analysis with strategic and behavioral perspectives. Reports should highlight not just what variances occurred but why they happened and how they affect long-term goals. Budgetary information becomes meaningful only when interpreted in context. Market conditions, operational risks, and strategic initiatives must be considered. Integrating KPIs, benchmarking, and qualitative insights enables management to assess efficiency, effectiveness, and adaptability. Ultimately, budgets must evolve from control tools into enablers of continuous improvement and strategy execution. When used judiciously, they support goal congruence by aligning individual performance evaluation with organizational success, turning financial discipline into strategic advantage.